Hello students, I hope you all are well and healthy. Today we are going to discuss capital budgeting and capital budgeting techniques. Before that, I welcome you all to Career File channel. Let's start. Capital budgeting is the planning through which companies try to evaluate different projects and invest in that project which gives the maximum return to the company. So suppose there are 4 projects A, B, C and D. The company will choose the out of 4 projects which gives the maximum return to the company. So it is the process through which company analyze the cash inflows and outflows to determine whether the expected return meets a set benchmark. Benchmark can be, suppose the company wants a return of 10%. So if the company are able to get 10% or more result from project, that project will be selected by the company. So investment decision can be made for building a new plant, by buying a replacement of the new machinery, or developing new product, or buying another company, and such as a different investment decision can be made. For example, if a company wants to manufacture mobile phones and at the same time it has an option to acquire a company who is already manufacturing the same product, that is mobile phone, so it will analyze whether it is beneficial to manufacture itself or acquiring the existing company. So if I will assume that manufacturing itself will giving a return of 10% within a 5 year, and acquiring existing company will giving a return of 5% in a break-even period of 4 years, then definitely company will go for manufacturing itself. So these are the analysis can be done by the company to whether which project should be selected by the company to get better result and to increase the wealth of shareholders. Why we need capital budgeting? It can be for forecasting of the sale, it can be for the comparative study of alternative project. If we have different kind of project and we have to decide which project should be selected, and we have also cash forecast, it will help in cash forecasting, and the last, the shareholders wealth maximization, it will help how the shareholders wealth can be maximized. So today we are going to discuss the capital budgeting techniques. So capital budgeting techniques are 2 types, that is the traditional method and another is the modern method. So in this video we will discuss the traditional method. These are payback period and another is the accounting rate of return. Let's start with the payback period. Payback period is the total time duration in which the cash outlay is covered. That is, if the company has made an investment, so in the payback period it will decide in how much period the total initial investment is going to be recovered. That is, it will help in deciding which project should be selected on the basis of time duration. Payback period. Payback, it means we have made an investment, we have paid for the investment, and in return cash inflows are coming to the business, that is our payment is getting back. So it is overall how much time period it is taking to recover or to come at the break even point. So it is called payback period. In this we rank the length of payback period and we decide which project should be taken. So the decision can be made on the basis of period of return or with the help of benchmark period. So if there are mutually exclusive projects, then definitely the company will select those projects which gives return in the shorter period. And if the company has decided benchmark period that it needs to recover the amount invested in 5 years, then definitely if the project are able to meet the benchmark period, then it will be selected, otherwise it will be rejected. With the help of this example, we can understand what is payback period. So the company has two projects, project A and project B, and the initial outlay is 50,000 rupees. So the company will decide which project is giving faster recovery of the amount, that is the project in which we are able to recover the amount in shorter duration of time. So in project A, we can see the cumulative cash flow is 50,000 and which is going to be recovered in 4 years. In project B, we can see that the amount of 50,000 is getting recovered in 5 years. So if you decide, then definitely project A will be selected as it is recovering the amount in just 4 years. So I hope you have been able to understood. So there are some shortcomings of this method, that it doesn't consider the time value of money, and on the same line it consider only cash inflows and profitability is ignored. Profitability, this point we can understand with the help of this example, that in the year 6th, 7th and 8th, the project A cash inflow is 0. So overall cash inflow of project A is 53,000, but in the project B, in the period 6, 7, 8, it is giving a return of 10,000 each year. So total inflow of project B is 80,000. In this method, it ignores the profitability of the project. Now let's discuss about accounting rate of return. So it measures the profitability of an investment by accounting profit. So basically, what is rate of return? Rate of return is the percentage term through which the company is able to get return on its investment. Basically, it tells at what rate of percentage company is getting return on its investment. So the formula is the average net profit after tax divided by average value of investment multiplied by 100. With the help of example, we can understand this also. So here we have assumed the initial investment of 16 lakh and net profit of 52,000, 56,000, 59,000 and 57,000 in year 1, 2, 3 and 4 respectively. So we have calculated average accounting profit of 56,000. Average accounting profit, how it will be calculated? It will be calculated by summing of the net profit of total year and divided by the duration, that is here 4. So we get average accounting profit of 56,000. Average investment, how it will be calculated? It will be calculated by initial investment and at the end of period the investment, assuming that there is no scrap value. So initial investment, that is the beginning investment, and at the end of investment divided by 2. So it will give the average investment. So here 16 lakh divided by 2 gives you the average investment of 8 lakh. Putting the formula, we will get the return of 7%. So in this method, how we will decide which project should be selected? In the same way, there can be a cut-off rate and there can be a mutually exclusive project. So if there are more than one project and if we have decided that rate of return should be more than 10%, so if the project is qualifying the cut-off rate, then it will be selected for the investment. And if the project is mutually exclusive, then those projects will be selected which gives the higher return. So I hope you have been able to understood this method also, and this method has also some shortcomings, like it also ignores the time value of money and uses accounting profit it can be calculated in different ways. So these are the shortcomings of this method. In the next video, we will discuss about the modern technique, also called time adjusted or discounted cash flow techniques. So if you have any doubt, you can ask in the comment box. And if you are new on this channel, please subscribe and share it. Thank you.